It is Monday, April 20th, 2020. It is 8 p.m. Pacific Standard Time, and so you know what time it is. It's time for a little bit of coin metal. And unfortunately, it is a lot later than 8 p.m. Pacific Standard Time. It is, in fact, 8:28 Pacific Standard Time. Unfortunately, I got out there on the water today, and it was just a little bit longer than I had wanted to stay out, but I was successful in catching a fish, so I don't feel too bad about it. Only in that I couldn't be here a little bit sooner. My apologies on that. But nonetheless, we will get forward, and we will get on with it. But yeah, no jiu-jitsu at all today, not even virtual jiu-jitsu. Hopefully that's going to end soon. There's been increasing talk of relaxing the lockdown and getting us all back to relative normalcy. But I kind of predicted something like this a long time ago, where I was listening to what was going on with regard to Trump and trade, with China specifically. And it seemed like things weren't going really all that well as far as the negotiations were concerned. And things kind of sputtered along for a little while there, but then all of a sudden they stopped. And the first place that really showed up, as far as I'm concerned anyway, has been finance. You know, is that people have to take out loans in order to buy things, in order to put those things on shelves, in order to sell them, make a profit, and then pay back the loan. Well, you know, you can only carry that along for so long, especially when you're not actually recovering enough to make yourself whole on your loan. You can only do that for so long before it catches up to you. And I really felt like that's what was going on, that, you know, there was all kinds of money, there just wasn't any product. And, you know, for whatever reason, the prices and the products weren't matching up, and that eventually we would notice this on the store shelves. And underlying it all, that's kind of where it was noticed first, was with regard to TP and a few other items. But anyway, I was talking about this like years ago, like probably like a year and a half ago, where I felt like Trump's position was this, that he had to put them in a position where trade with China, trade with China, was no longer feasible in terms of physical goods coming across the ocean, 8,000 miles. That whole model was going away. You know, simply because the energy required to get the items, as cheap as it is per unit, it still costs money, and it's still more than they were able to afford. You know, so that kind of catches up to you after a while. If you can't afford to fill the tanks, you can't afford to set sail, you can't get the shit across the ocean, so on and so forth. I mean, we'd already had a stagnation with regard to consumer spending. You know, I mean, people were getting kind of burnt out on the new iPhone every fucking year that had only just one or two minor iterative tweaks that, you know, made it necessary to where you needed to have it. I mean, basically, the only people that really need to have it are people that need to have it to communicate to others that they have it. You know, whether or not they can actually afford it. It's a whole different story there. But anyway, you know, the thing that I'm going with here is that he understood that our current policy with regard to energy at the time that he started on his little jaunt here, he understood that the underlying energy issue was going to be untenable enough to catch up to us. And specifically with regard to shipping stuff across the ocean, as it had already caused some disruptions on that, in that the energy costs had gotten expensive enough that the cost offset of shipping stuff from China suddenly went away. And so, this is an issue that has been coming for quite some time now. That, the people in China, they've been dependent on our consumer spending for 30, 40 years now. And they're getting into their second and third generation of people that are wanting retirements and wanting the nice 2-car garage house and, the fucking 4 bedrooms and shit like that. I mean, they have those expectations because that's what their job could give them that a job couldn't give them before. Well, the thing that sustains that is us and our consumer spending. And, fortunately for them, their expectations for what a lifestyle was expanded, and they were able to uptake a lot of their domestic supply, lacking our demand. But at the same time, they don't really have the same culture with regard to consumer spending and innovation and all that other business. So they're really in a neat place where they can divest from us entirely, and they can be in a bit of a leadership position, but their methodology, and I had just a teeny tiny taste of it when I was working for Hyundai, that they have a very, very insidious way of dealing with people that stick out. Whether it's you're performing better than you should in your area, or other people around you aren't performing as well as you. Something to that effect. Whatever it is. The leadership hierarchy is established as such that somebody is to blame for it, and it will most likely be you. You will most likely be punished for it, whether or not it's actually your fault. And if you try and say anything about it, and it's like not part of your job or something like that, and you're not tactful enough in the way that you communicate it upstairs, you get fired. You get reprimanded. You get other people trying to get you written up for bullshit. And they were doing that here in the United States in the fab that I was working at, and to me. And so, okay, you can go ahead and play that way, but eventually you're going to knock out all of the people that give a shit about the job. You're going to end up with nothing but the people that sit around there and look at the computers all day and not actually do the job. And so that's pretty much what happened, is they got rid of anybody that was competent or too competent for their position. And they ended up collapsing because they don't have the same culture here that they do there. There were tolerances where managers would get instructions to do, and then they would be like, no, I'm not going to do that. Okay, you're fired. and it would just go over again. But anyway, that there's those little differences, between the way that we do things over here and the way that they do things over there, that they really inhibit innovation. They really do. And they become kind of dependent on us to develop the new ideas that they can copy. And that's because a long time ago they erased that I don't think they erased it, but they certainly stifled the shit out of their innovative spirit, their entrepreneurial spirit. And it's caused it to express in its more pernicious forms quite excessively. Specifically, not giving a shit about how you make the money, just making the money. They picked that habit up from us too. If they didn't already have it, I would imagine they do, or did. I don't know. Anyway, point being is there's little addendums, there's little associations that go along with that kind of stuff, and invariably they get dragged along with them. And so I think that we're kind of in that this weird spot where they're trying to drag us here in the United States to be more totalitarian, whereas over in China they're having no choice but to face an ever more liberal society. And I know that's kind of a slightly naive way to put it in the vocabulary, but that's more or less what's going on there. Anyway, let's go ahead and throw down with some music. And you know we're going to start with some body count. But I've been wanting to play this other one that I haven't played in a while. Talk shit, get shot. First Dance, here on Coin Metal. And that was rude. That was Prong with Rude Awakening. Alright. So, as far as what we're going to get into today, I did a little bit of digging around and found this one. And it's quite interesting, although not entirely unexpected. At least not for me. I've regarded these DeFi projects with much chagrin and, a lot of aloofness. I don't have a whole lot of confidence in them, mostly because they're trying to build on other people's work, and I think that if I want to do something like that with my Ethereum, that I can do that already without the need for an additional entity in there. And so, and it surprises me the most because they're like, most of them are trying to occupy that position of being the issuer and the controller of the currency, and they think they're going to get to reward themselves unduly, of course, and fuck everybody over. And no, there are plenty of frameworks that just prevent people from just like arbitrarily pulling some mean shit on other people. There are some frameworks out there for that. Although they don't seem to work very well, I must say. Sorry about that. Try not to drink into the microphone, but these things happen. Anyway, so this first article here I got is on Cointelegraph.com. dForce loses 99.95% of funds in latest test of DeFi resilience. Leading Chinese DeFi protocol has lost 99 blah blah blah. Okay, and let me see if I can find the author of this thing. Samuel Hague. So yes, penis. And when was this thing authored? This picture is really, really huge, and it kind of obscures when it was authored. Oh, approximately 1 hour ago. Let me refresh this thing. It's probably like 13 hours ago. April 19th. So yesterday. So yeah, now scroll all the way back down here. Chinese decentralized finance, or DeFi protocol dForce, has been exploited in a $24.95 million hack that has resulted in its LendF.me lending platform going offline. According to DeFi data aggregator DeFi Pulse, which we're going to follow up on, the total value of funds locked in dForce's protocol has fallen from almost $25 million to just $10,000 overnight. On-chain data indicates that these stolen funds have been moved into top DeFi protocols Compound and Aave. dForce loses over 99.95% of locked funds in attack. Mendeo Yang, the CEO of dForce, confirmed the attack on the project's Telegram channel, announcing that it was attacked at 8:45 a.m. on April 19th during block height 9,989,681, or 9.989.681. Anyway, continuing. He stated that the dForce team is currently investigating that attack and requested that users to not place any assets on the lendf.me platform. The attack is believed to have targeted a vulnerability inherent in Ethereum's ERC-777 token standard. The ERC-777 vulnerability believed to facilitate a hack. The same exploit was used to drain more than $300,000 in wrapped Bitcoin from smart contracts on the decentralized exchange DEX Uniswap, containing IMBTC and ERC-777 based tokenized BTC operated by DEX Tokenlon. In response to the attack, Tokenlon announced that no BTC held in custody had been impacted, adding that they had temporarily paused IMBTC transfers while considering its next move. dForce integrated support for IMBTC lending on lendf.me platform in January, leading to speculation that it may have also been used to exploit dForce. dForce attacked days after multi-coin capital investment announced. dForce's devastating attack comes less than a week after crypto venture firm Multicoin Capital announced it had led the DeFi protocol's $1.5 million seed round. Multicoin Capital principal Mabel Jiang told Cointelegraph that dForce was building DeFi's first super network of decentralized protocols, likening the project to Asian super apps WeChat and Alipay. Since launching in September of 2019, dForce's lendf.me had grown to comprise the 7th largest DeFi protocol by locked assets prior to the attack. Yeah, the incentives hit high enough, i.e. $25 million, and somebody snatched it. Why is this so hard for anybody to understand? I don't get it. I don't get it. Let me see if there's some links on this thing, because I want to follow this up. Let's see, because that doesn't seem to be on the right. DeFi Pulse. Let's see here. That's not it. Let me see if I can find anything more on this bad boy. No, not that. DeFi aggregator, blah blah blah. Same exploit, BTC announced. dForce integrated. Huh. Interesting. dForce brings IMBTC to DeFi lending. Yeah. This seems like something I should follow that one up with, because it'll be interesting to find out what this thing is, and it might give us a little bit of insight on exactly how the attack was pulled off. And of course, if we can find any additional data on that, we'll follow it up on that too. And this one's on medium.com, and I'm supposing it's by Tokenlon Dex. dForce brings IMBTC to DeFi lending. Our friends at dForce have integrated IMBTC. Let's look at that. Let's look at what IMBTC is, because that's what we do. IMBTC, more accessible Bitcoin. Oh, wait a minute. Get back here. Oh. Ooh, this is interesting. Okay, so this is a project, I guess this started somewhere back in November of 2019. And anyway, I've hunted down their Medium white paper, or I guess, like their first synopsis or like something. Anyway, check it out. This is on medium.com. IMBTC, a new kind of Bitcoin. And this is by IM Token, and it was authored November 14th, 2019. Yeah. DeFi. Decentralized finance is the hottest topic in the blockchain industry in 2019, attracting many technical research and capital. Value locked in Ethereum's DeFi ecosystem has reached a total of $616.8 million from $274.6 million at the beginning of the year, with hundreds of thousands of wallet addresses also participating. This year we also look at some achievements within the DeFi field. Tokenlon Dex launched a 3-month transaction volume of 59,696,279 with 225,000 users, and Tokenlon topped Dex ratings a couple of times. The transfer volume of stablecoins in the past 30 days was 994,772,238, of which USDT ERC20 tokens accounted for 16% of the whole network. At the same time, the application brings millions of dollars in traffic to DeFi applications such as Partners, Maker, CDP, and Compound. Being deeply involved in Ethereum's DeFi ecosystem, you will find that BTC has good liquidity on centralized trading platforms and financial services, while DeFi applications on Ethereum lack of quality liquid assets as collateral. Things that cause typical finance applications like Maker, CDP, and Compound to have a hard time to scale further. Comparing the market value of DeFi, Ethereum, and Bitcoin, we find that the combination of the liquidity of Bitcoin being placed in the DeFi ecosystem will have immeasurable potential. Probably not non-existent. What is IMBTC? Tokenized BTC is able to work with smart contracts, seamlessly integrate into decentralized transactions and financial services while injecting liquidity into the Ethereum ecosystem. Imagine that this programmable Bitcoin you own will seamlessly interact with smart contracts, whether DeFi, staking, or DEXs. In addition, the token also has a 15-second block confirmation time, as well as real-time earnings. This is like Bitcoin, but without the downsides of Bitcoin. We at Tokenlon named the project's token IMBTC, which is an Ethereum token issued with a 1-to-1 anchor to BTC. What does that mean? The holder can transfer, redeem, and exchange IMBTC as well as receive an income share of the Tokenlon platform fees while holding IMBTC. IMBTC's features. In order to give you a better understanding of IMBTC, we will briefly introduce the following points. Deposit to receive IMBTC. If you want to get IMBTC, you simply send BTC. It is that simple. At the same time, you can also destroy IMBTC through the dApp or directly call the smart contract. Just wait a moment and you'll receive your BTC. There is no authentication needed, no lockup period, everything feels swift and easy. We hope that the low friction in the process makes IMBTC a financial asset that is more accessible for the general public, not just for geeks. Who minds it, I wonder? Enjoy instant income. The token is accruing value which is added to the token value. I wonder where the value is coming from. Since storage costs and trading risks can make your blockchain assets volatile, with no interest rate mechanism to offset these costs, holding a token is not incentivized. We wish that IMBTC holders will benefit from the liquidity of IMBTC. Therefore, we will distribute the transaction fee from purchasing IMBTC on TokenLawn to users who hold IMBTC. When a user purchases IMBTC at TokenLawn DEX, the smart contract deducts 0.3% IMBTC as a transaction fee, and the commission will accumulate in the smart contract. Any user can initiate a dividend request through the dApp or directly to the IMBTC smart contract. At this time, the smart contract will automatically pay dividends according to the IMBTC currency ratio, and the wallet address holding the IMBTC will receive the corresponding interest. IMBTC dividend algorithm. And see here, it's exchange rate square root of new equals whatever. For example, TokenLawn issues 100 IMBTC and Alice holds 10 IMBTC. When TokenLawn receives 1 IMBTC fee, the exchange rate is 1 times 100 divided by 100 minus 1 in parentheses equals 1.0101. Okay. At this point, Alice will receive a dividend of 10 times 1.0101 minus 10 equals 0.10101 IMBTC, and her balance will be 10.10101 IMBTC after the dividend. Seamlessly exchanged. TokenLawn DEX is based on the 0x smart contract. Its innovative mechanism creates a fast, best price trading experience. The trading assets are completely controlled by the user, and the token exchange can be completed quickly without recharging or withdrawing. Users with IMBTC can quickly trade tokens on the TokenLawn DEX, enriching your portfolio and spreading the risk of price fluctuations. These fucking people smoke crack. Trusted and transparent. The hosted address of the IMBTC will be publicly released. Through the proof of reserve on the chain, all IMBTC issuance and destruction can be clearly tracked, and the BTC reserve is guaranteed to be 1-to-1. Anyone can openly audit, fully transparent. However, we admit that the current IMBTC is still not perfect, as is the case with most blockchain financial products. Due to the limitations of blockchain technology, it is impossible to achieve both the ideal decentralization and ease of use. Therefore, we choose to adhere to the principle of security and transparency and temporarily use centralized hosting to make IMBTC easy to use so as to better popularize usage. At the same time, TokenLawn is also planning on how to transform centralized hosting into a DAO, decentralized autonomous organization hosting solution that remains decentralized yet easy to use. These fucking people smoke crack. We believe that with the development of blockchain technology, we can work hard to make decentralization a reality. Future outlook. IMBTC as a token project is currently online on IM Token 2.0. open IAM token to experience transfer, redemption, etc. They put redemption in there twice while holding IMBTC while enjoying instant benefits. The birth of IMBTC is not out of thin air, but based on the past experience and precipitation of the blockchain community. We sincerely thank WBTC, TBTC, EOS, Rex, Uniswap, Aragon, Polkadot, and other projects for their continuous inspiration. We look forward to IMBTC coming from the community and giving back to the community, providing better financial application services for each user, and injecting new vitality into the ecology of Ethereum. In other words, give me your money! Ooh, and nobody responded to this thing either. That's amazing. So this is the way that $25 million was just fucking ganked? Are you fucking kidding me? You know what? If you gave your money to this thing, you deserved to lose it. And there is not a regulatory entity on planet Earth or anywhere else in the known galaxy that would be able to protect you from the level of stupidity that'd be required for you to willingly participate in something like this. I mean, this is not just, somebody who doesn't know English or something like that. This is, you obviously didn't read this. You didn't read the material concerning this Meow project before you threw money at it. And so, again, there isn't a regulatory entity on Earth that's going to protect you from this level of stupidity. You obviously, if you gave these people money, you don't know why you're here, you don't know what you're doing, and you really need to go back and read the white paper. If you take the word DeFi seriously, you need to go back and read the white paper because you're doing a lot of trust by default. It's like, I'll give you an example. This thing, the IMBTC dividend algorithm. Okay, where is this fucking dividend coming from? If it's just a nick off of somebody else's transactions, that's a transaction fee. Okay? But I would wager that at one point or another, these guys didn't have the Bitcoin to cover on one side, and so the hack is just to give it a nice little cover, that they probably already blew the money or they never actually had it. And they've been operating on fractional reserves. They had maybe $100 worth of Bitcoin behind this thing, if that, that they'd tied up in some sort of ERC20 token, or no, ERC777 token, and this is just fucking silliness. Like I said, if you're giving these people money, or if you're giving projects that sound anything like this your money, you're going to lose it. And that's all there is to it. They give you a lot of trust things. And just, I'm going to give you some examples because you're going to see way more of this shit. Your Twitter feed is going to get blown up with, DeFi this, and this is better than Bitcoin. This is a better version of Bitcoin. This is Bitcoin for a new world, or some shit like that. And it'll all be bullshit. Okay, and so the first thing that you got to watch out for is associations to things that are already of authority or of known quality as far as authority is concerned. So when you hear people say the words blockchain, Bitcoin, Ethereum in association with their project, say it's like this, where it's only loosely associated with Ethereum, and that the transaction to initiate this contract or whatever happens on the Ethereum network, and you can monitor some of the transaction activity where it actually contacts with the Ethereum blockchain. But that's it. And there's no oracles and stuff that can see up your pants to the extent that would be required to be monitoring every single one of these little tokens. And to a large extent, these entities, they're taking it upon themselves, the responsibility to be the entity that does monitor shit, that is doing the KYC due diligence. And if you're not doing those things, not only are they going to nail you for being an unlicensed like exchange or some shit like that, if they can catch up with you, it's one of the advantages of doing things in a quote-unquote decentralized nature, i.e. you just like contribute code to a mutual depository or repository that people can download it from, as opposed to trying to exist as some sort of like corporate entity or whatnot, like, say like a Ripple, where they're a corporate entity that makes most of their money by selling tokens to the exchanges. If you're one of these, and they will eventually get caught up with on that, I have all faith in that. But anyway, so you got to watch out for any kind of association with an existing thing of value. So when people are talking about like a commodity-based coin, like an oil-based coin or a gold-based coin or a diamond-based coin or a sex coin or whatever, the thing is that you cannot intrinsically connect a real-world item or service to a coin on a cryptocurrency network. That is, you can only represent it, and of that, you can only represent the transaction where it was actually transacted. So like when I bought it from somebody or when I sold it to somebody. But that's it. For all you know, they walked down the street and somebody whacked him over the head with a wrench and ganked it from him. Or they handed it off to somebody else and got another medium of exchange in exchange for it. You don't know. I don't know. Nobody knows. Anyway, so that's, the biggest issue that I have with any of these tokens is that they are making a lot of assumptions with regard to value, and they're trying to build things like retail based networks. So like you go into their little retail network and you're transacting these tokens instead of Ethereum or Bitcoin within their little marketplace, and that they're going to cash it all out and you're going to get your stuff. And that idea is fine. The problem with it is this, that Bitcoin has its own valuation. Ethereum has its own valuation. And so even though the transaction happened on the Ethereum network, there's nothing that intrinsically binds the Bitcoin to the Ethereum network in such a way that you can like mysteriously extract some sort of additional value out of it. All you can do is document that you moved the coins from one person to another. And within the Ethereum realm, but not what they were actually worth at any one time. And so you could tie up, say, $1,000 worth of Bitcoin in one of these contracts right now, right? It's $1,000 worth of Bitcoin right now. In an hour, the amount of Bitcoin it's worth, or the amount of US dollars that amount of Bitcoin is worth, will change. And so will the value of all of the little tokens that you've issued against that volume of Bitcoin. And then again, you've also got the thing of Ethereum, where it's going up in value or it's going down in value. Its network is a little more congested, your transaction fees go up. All of these things affect the mechanics of what the transactions actually cost to clear to do final settlement on a lot of these things. So like if you're trading out some of your IMBTC for your Ethereum volume or the Bitcoin volume and freeing it up or whatever, that transaction actually costs something. And so again, you're running into this place where those transaction fees themselves can be an adjustable thing. The network isn't obligated to make space just for your transaction just because it's got $25 million tied up in it. That's completely irrelevant to the network. The network's looking at it and saying, look, dude, I had another $780 billion behind you, so let's move it along. But these value adjustments like that, again, they don't seem, they seem ephemeral right now. When we're not seeing like massive spikes in the value of Bitcoin in US dollars or Ethereum in Bitcoin or Ethereum in US dollars or whatever. And when we do see them though, that's where we're experiencing issues with, again, transaction fees costing too much. The contract can't close, or the contract closes early and fucks everybody all up. And besides that, you have people attacking them now too, because you've adjusted the incentive to where it's more valuable to attack it, to play maliciously, than to play according to the rules, which is what mining is supposed to foster. Again, this is a lesson we are going to learn. It's going to take us maybe another year, maybe another 2 years. I think that the big clincher is going to be where governments really try and force forward with stable coins, where either through an international body or individually, countries will be switching to having a tether type equivalent in the crypto space. And I see that as being the danger point, because we are going to see where they are attacked. And this is as plain as I can possibly state it. They'll get attacked, and then they will point back at us and say it's our fault, or it's the fault of cryptocurrency or something like that. And it's not our fault, because according to the way that Bitcoin is supposed to work, you're not supposed to have so much value on one transaction that it motivates people to cheat, to try and acquire it illicitly or by illegitimate means. But it's always a matter of incentives. And when you just allow mining to work the way it's supposed to, people will work to maximize their individual efficiencies, even if that does mean cheating. Initially it might be regarded as cheating, but later on it might be adopted as a regular practice. As we've seen with like ASIC boost or ASICs to begin with, and then ASIC boost. Yeah. Anyway, let's go and throw back down with some music. And as far as where to go, I've got some ministry in front of me, and that seems as good a place as any to start. Let's go with Rio Grande Blood here on Coin Metal. And that was Tool with Vicarious. Alright. So I did some hunting around. Okay, I looked for some stuff. And I found some stuff. And I swear, if investment advisors could investigate shit as quickly as I can, I swear that half of this space would either not exist, or it would at least be like more legitimate than it currently is. I mean, because literally, there are projects that launched back in like 2012 to, not that early, like 2014, 2015, 2016, really, really early, especially like 2014, 2015, that were more legitimate on their face in both their intent, their objectives, and the thing that they thought they could achieve, the actual ability to achieve it was achievable. But it's like people are taking leave of their senses, just trying to chase any kind of value whatsoever, and they're getting sucked in by buzzwords again, as if this ever really changed, right? The buzzwords themselves change, but you notice there's this one fucking buzzword, and for one reason, it does. For some reason or another, I don't know why. I have suspicions why, but for some reason, this word blockchain, it won't fucking go away, and it keeps catching people unawares because they have no fucking idea what they're investing in. They have no idea what the quote-unquote underlying technology is that they're so excited about that they got to throw millions of dollars at it. Let me tell you something. The average project back in that time, 2014 through 2016, the average project, the most expensive fucking thing that was involved in it was having somebody construct a half-decent website for you. And investing in PR campaigns. That was like those were the big expenses. And that was just making people aware of shit. It wasn't in trying to rip them off. It wasn't in trying to mislead people. But I'll tell you, man, the more you hear buzzwords it as filler for like some actual material, and you'll hear it. You will hear it. It's like there used to be a few buzzwords that, like, if I heard them, I knew immediately I was being pitched, and most likely somebody who was kind of raised up within the Amway, kind of rubric of marketing, because they would all use the same little trigger words. Turnkey. That was a big one. Turnkey. Anytime you hear those two fucking words, turnkey, dude, that person is pitching you something that is most likely opening a door to hell. You can turn a lot of keys, and some of them you really shouldn't turn. Some of them will lead straight to financial ruin, and you got to watch out for those. But anyway, so I did a little hunting around, and my gosh, it's something where I sense that people are not doing their due diligence. And because of that, they are going to get sucked in. They are going to lose a lot of money. And the existence of the CFTC or FinCEN or the SEC or the participation in these entities, the NYDFS, all of these entities will not fucking protect people from this level of stupidity. If you're acting with money on this level of trigger, you're gonna. I can't name something that you wouldn't throw money at, even knowing that you're probably going to lose it. So, anyway, I found this. It's on Medium, I'm assuming, but it's Multicoin Capital on forking DeFi protocols, and this is by Kyle Samani. So yes, penis. This was authored April 16th, 2020. And here we go. A suite of new Layer 1 blockchains are launching. I've been thinking about Ethereum's network effects and the defensibility of the DeFi protocols built on top of Ethereum. A couple of years ago, I wrote about the network effects of non-sovereign Layer 1 monies like Bitcoin and Ethereum. Since then, The DeFi ecosystem on top of Ethereum has blossomed. Utilizing a couple dozen DeFi protocols, users have withdrawn a few $100 million of debt fully collateralized against an even larger pool of capital. Now that these protocols are collectively facilitating a few $100 million of economic activity, it's possible to reason about defensibility. One way to do this is to quantify and compare network effects. However, it is very difficult to quantify network effects with precision, since the underlying dynamics of each protocol are unique, making it challenging to compare on an apples-to-apples basis. In this essay, I'll consider number 1, the effect and capital required to fork each of the major DeFi protocols. Then I'll rank the relative strengths of these network effects and conclude with a discussion of Ethereum's ecosystem level defensibility. This essay assumes working knowledge of each protocol. Synthetic stablecoin, Maker. About a year ago, I wrote about how Layer 2 assets such as Maker, the equity of MakerDAO ecosystem, can capture value with permissionless open settings. In that essay, I specifically identified the presence of the unforkable state as the key to value capture. In the context of Maker, the obvious unforkable state is the collateral, primarily Ethereum, backing the DAI loans. However, it is now clear that this framing is incomplete. To understand why, let's assume that the only source of the network effect for Maker is the collateral. A wealthy third party could fork all of Maker's contracts, create an alt-Maker ecosystem, and deposit tens of millions of dollars of collateral to bootstrap liquidity. But what then? The alt-Maker system is useless if no one wants to buy or interact with alt-DAI. Maker's most potent source of defensibility is not MKR or the collateral backing the DAI loans, but the liquidity and usability of DAI. DAI must be liquid in order for Maker to be usable. If someone withdraws DAI debt against Ethereum collateral, the DAI is useless if there's no liquidity, but usability is a superset of liquidity. Oops, hold on a moment. Drop my volume. There we go. A little better. But usability is a superset of liquidity. DAI's usability is a clear acceptance by merchants, its use in other protocols like Augur, and its use as collateral in lending protocols like Compound and LendF.me. DAI is plugged into all kinds of third-party apps, services, and infrastructure, and that makes it more useful and usable. Not necessarily. The combination of DAI's liquidity and usability is a powerful moat. A well-capitalized alt-maker team could offer a higher DAI savings rate, DSR, and pay third parties to integrate alt-DAI, but it's unclear if this would gain meaningful traction. Fiat collateralized stablecoins. And we want to note right here, or I want to anyway, that I've never believed that Tether actually has the US dollars or even the IOUs, the collateralized equivalents, cash equivalents that they can't claim to have, supporting $7 billion worth of liquidity floating around out there. I just don't. Continuing on. Fiat collateralized stablecoins, USDT. While Tether is not a pure DeFi protocol with an outstanding market cap of over $5 billion, I included it because it's such an integral part of the crypto ecosystem. No, it isn't. We could shit can it tomorrow. Everything would be fine. The source of the defensibility for USDT is clear. It's the most liquid asset in the crypto ecosystem alongside BTC. It is available on all major non-US exchanges, serves as collateral for many derivatives exchanges, and is used to settle a huge percentage of OTC trades. Despite fierce competition from USDC, PAX, TUSD, GUSD, DAI, and others, USDT still commands over 80% of the stablecoin market, measured using market cap. This is the ultimate testament to the defensibility of USDT. No, it isn't. It's the ultimate testament to how vulnerable the entire crypto ecosystem has been made because it's balancing on a fucking illiquid asset. Continuing on. There are a few teams that are working on stablecoin clearinghouses, including DeFi protocols such as Stablecoin Swap and Shell, and centralized clearinghouses like Stablehouse. If these are successful, and therefore reduce the friction associated with trading stablecoins, USDT may be negatively impacted. For example, if these protocols/companies provide strong guarantees that large quantities of stablecoins can be swapped with minimal slippage, derivatives exchanges may begin to accept other stablecoins as collateral. Today, FTX offers this service natively. However, the presence of liquid stablecoin clearinghouses may accelerate this trend, which is likely bad for USDT. Collateralized money market compound / lendf.me. The unforkable state in compound is the collateral. Therefore, the defensibility of compound can be understood as follows. As the value of collateral pool increases, borrowers can borrow more capital, which draws more lenders, etc. What if it doesn't? That's like a Ponzi scheme, it sounds like. How difficult is it for someone to fork compound and bootstrap liquidity in alt compound? There are a few ways to do this. The alt-compound team can support assets that compound does not support, ergo USDT, or a modified ERC777 smart contract introduced more favorable collateralization ratios and liquidation penalties. Lend their own assets in the alt compound pool at a competitive or even discounted rate. Subsidize third-party lenders to undercut compound's rates. Today, Compound has less than $100 million of collateral. If the creators of alt compound undercut compound's rates by subsidizing users, for example, on the order of 100 basis points per year, the annualized opportunity cost of bootstrapping liquidity would be less than $1 million. This level of scale is venture fundable. Sounds like it was, right? However, in addition to Compound's internal liquidity in the form of lending and borrowing rates, Compound is also subject to a couple of unique forms of external liquidity that may provide additional defensibility. First, there are third-party aggregators such as Instadap, Zerion, Ray, Idle Finance, Aave, etc. These systems route deposits to Compound, which in turn lowers borrowing rates, which then attracts more borrowers. While organic capital flow is certainly good, it's not clear that it matters on the margin, since an alt compound team can subsidize rates to bootstrap liquidity. Interestingly, the presence of aggregators can actually backfire, because the aggregators are incentivized to send user assets to the highest yielding lending pools. Assuming similarly trusted contracts, governance, and Oracle mechanics, aggregators will not be loyal to Compound at the expense of their users, and so an alt alt compound can easily win over aggregators with subsidies. Moreover, a sufficiently large aggregator can siphon liquidity away from compound into its own pool or alt compound fork. While this hasn't happened yet, I expect it will in the coming weeks. It says coming years, but yeah, this is like literally weeks ago that he wrote this. Overall, it's unclear if third-party aggregators will act as substantial source of defensibility. Apparently they're not. Second, let's consider C tokens. C tokens are somewhat analogs to DAI if third-party apps integrate C tokens, for example, for use as collateral. That makes C tokens more usable outside of the core compound protocol. That makes it difficult for lenders, C token holders, to move from compound to alt compound. And again, they're describing a theoretical here, based on an existing one compound. Anyway, continuing on. While the maker/DAI compound/C token analogy is good, it's not perfect. The only reason to create DAI is to sell it for something else, ergo more Ethereum. Therefore, alt maker is useless unless there is a market for alt DAI. However, this is not true for compound. Compound is still useful even if third-party apps do not utilize C tokens. Empirically, this is playing out as one should expect. The China-based dForce community forked the compound codebase and launched a collateralized money market protocol called lendf.me, and they've already bootstrapped $20 million of collateral into the system in just a few months. They've accomplished this by, number one, offering products that Compound does not support, notably USDT, IMBTC, and HBTC, localizing the service with third-party integrations for Chinese users. That was number 2 on there. It does not appear that the dForce community had to subsidize rates on the lendf.me product to accomplish this. No, it was incentivized by the fact it was set up specifically to steal people's money. There you go. Maker is more defensible than Compound. With a subsidy budget, anyone can fork Compound and bootstrap liquidity internal to the lending/borrowing market. But successfully forking Maker requires more than a subsidy budget. It requires liquidity and usability of DAI external to the protocol. Generalized synthetic asset protocol synthetics. Synthetics is a specific type of exchange focused on trading synthetic assets. The defensibility of exchange is generally understood to be a function of liquidity. However, synthetics is not a traditional exchange because it does not offer a central limit order book, CLOB, like virtually all major exchanges across traditional markets and crypto markets, ergo NYSE, CME, Coinbase, and Binance. One of the defining features of synthetics is that takers do not incur any slippage when trading synths against the collateral pool. However, liquidity is limited based on the amount of collateral in the system. This means that liquidity, and therefore defensibility, is primarily a function of available collateral. Okay. Interestingly, the growth of the synthetics exchange is actually happened by the need for takers to onboard the synthetics ecosystem by trading real assets, non-synths such as Ethereum, for synths such as Ethereum. Today, most users onboard into the synthetics ecosystem via Uniswap, and the largest liquidity pool on Uniswap is Ethereum to Ethereum. While the need for a liquidity bridge is a constraint to growth, it is also conversely a moat. If someone forks the synthetic system to create alt-synthetics, he or she will need to bootstrap an analogous liquidity bridge. How do network effects of synthetics compare to maker and compound? First, let's consider the collateral in the protocol. Like in the cases of alt-maker and alt-compound, anyone who forks synthetics can capitalize on the collateral pool themselves or subsidize others for doing so. Therefore, the collateral base is unlikely to provide defensibility. Sounds like it just incentivizes people to rob it. Next, let's consider exogenous assets. DAI, C tokens, and synths. Unlike maker DAI, synths do not require liquidity external to the protocol by design. Instead, synths are more comparable to compound C tokens. Like C tokens, synths can be used as collateral in third-party apps, but don't need to be in order for the protocol to function. While this can become a source of defensibility, it hasn't yet. And it still hasn't. The last major form of defensibility is the real asset. Asset to synth bridge. While synthetic leverages Uniswap for this today, an alt-synthetics team could easily provide their own real asset to alt-synth bridge using Uniswap, Kyber, or any other freely available DeFi tools. Automated market makers: Uniswap, Stablecoin Swap, Shell, Bancor, FutureSwap, and Kyber. Compound is an automated market maker, AMM, albeit for borrowing/lending instead of trading. As such, the defensibility of most of the trading-focused AMMs can be understood to be comparable to that of Compound, excluding C tokens. Empirically, this seems to be the case. While not all of these AMMs are directly competitive because of different product focuses, ergo Stablecoin Swap and Shell are focused on stablecoin trading, while FutureSwap is focused on futures. The defensibility of each is primarily a function of the size of each protocol's liquidity pool. Whereas larger liquidity pools in Compound allow for tighter blending/borrowing rates, larger liquidity pools in trading-focused AMMs offer lower slippage for takers. Kyber has become the most liquid AMM over the past 12 months, largely by number 1, tapping into other AMM liquidity pools such as Uniswap, and number 2, because of third-party integrations that route taker order flow. It's clear that all the AMMs are going to tap into one another's liquidity pools as they continue to improve over time. Paradoxically, once all the AMMs within the given vertical, ergo stablecoin swaps, tap into one another's liquidity pools, all of those AMMs become perfect substitutes. None of the AMMs will be able to compete on distribution. The ultimate winner from this end state of perfect competition will be takers who will always receive best execution. Non-custodial central limit order book exchanges. DIDX, IDEX, NUO, and OX. The defensibility of these protocols are comparable to those of centralized exchanges, albeit with a few disadvantages. First, all of these protocols are subject to the constraints of the underlying blockchain, which ultimately settles trades, including non-deterministic order execution, high latency, and minor front-running. All of these constraints deter liquidity providers and therefore increase slippage. Second, in general, none of the decentralized exchanges support cross-margining or position netting. While I hope to eventually see this develop in the DeFi ecosystem, it's clear that this is years away. Meanwhile, centralized exchanges like FTX and Binance offer cross-margining today and are rapidly expanding their product offerings to maximize capital efficiency for traders. Yeah, I think all of this shit is going to end up getting smashed into a wall, but that's just my opinion on this. Mixer-tornado.cash. Tornado.cash is unique among other DeFi protocols above. While the others are focused on borrowing/lending and trading, Tornado is focused on mixing funds to maximize user privacy. Today, Tornado.cash does not support private payments in a pool. Rather, it can just be used to anonymize funds. The source of defensibility in Tornado is the size of the anonymity pool. Since funds cycle through the Tornado pool relatively quickly, the entire asset base turns over every 1 to 2 weeks. The network effects are fleeting. Moreover, beyond a certain point, a marginally larger anonymity pool doesn't really matter. For example, as the anonymity set grows from 500 to 1,000 addresses, it's not clear that the marginal user cares. Who is the marginal user who believes that one out of 500 isn't good enough, but that 1 out of 1,000 is? Thus, in its current form, Tornado.cash is not that defensible. However, in a future version of this service, Tornado.cash aims to support privacy-enabled asset transfers inside the privacy pool, rather than just anonymizing funds, which is what's available now. In this model, capital will be stickier, as it won't leave the system so quickly. This will allow the anonymity pool to grow much larger, making it more useful for larger amounts of capital, and will increase the incentive to hack it. The notion that large amounts of capital will only enter a large privacy pool is unique relative to other services above. For example, if the entire privacy pool is just 1,000 Ethereum, that pool may not be useful for someone wishing to anonymize 9,000 Ethereum, and, in fact, may be harmful for the first 1,000 Ethereum in the pool, as the owners of the first 1,000 Ethereum may not want a 90% probability of being associated with the other 9,000. For a user who wants to anonymize 10,000 Ethereum, they may require a pool of 90,000 Ethereum. This model may not yet be available, or while not yet available, is clearly more defensible than the status quo because it enables the wealthiest people to use the service, and the wealthiest people are the people with the largest incentive to hide their wealth. And also the highest incentive to retain their wealth, meaning they don't want to put it in a risky state, an undeterminate state, for about a week or so for some little kid in fucking Uzbekistan to figure out how to hack. Anyway, continuing on. Ranking. After considering the hypothetical difficulty of forking these protocols and the empirical evidence we have so far, which protocols have and have not been forked, I've ranked the defensibility of these protocols from the strongest to the weakest. Note that this ranking is necessarily conjecture, as it's impossible to quantify and therefore rank on a purely objective basis until you pulled off the hack. Number 1, fiat collateralized stablecoins, USDT. Number 2, synthetic stablecoins, Maker. Number 3, mixers. Number 4, generalized synthetic asset protocol. Number 5, collateralized money market. Number 6, automated makers or market makers, Uniswap, Bancor, FutureSwap. Number 7, non-custodial central limit order book exchanges, and that would be DYDX, IDEX, NUO, and OX. I ranked USDT at the top because it faces the most competition and is still 5 to 10 times larger than its largest competitor, USDC. Goldman Sachs coin. While USDT is controversial, it's clearly extremely defensible. Coinbase is one of the best capitalized companies in the space and has been unable to meaningfully displace USDT after 18 months. While it's possible that stablecoin clearinghouses may change these dynamics, it's too early to know. Yeah, it is too early to know because at one point or another, USDT is probably going to end up getting hacked, and they're going to find out that they don't actually get anything out of it, other than maybe the transaction fees that are within the transaction itself, and maybe what little coins are actually staked on it. But it won't actually give them access to the underlying US dollars because the underlying US dollars don't actually exist. Continuing on. Based on the commentary above, it should be clear why Maker is next. The Maker protocol does not function if DAI is not liquid and usable external to the core protocol. Both of these traits are not easily forkable or subsidizable. You know, there's one aspect of all of these that this entire paper does not take into account. And that's the possibility not of these individual projects being forked, but of Ethereum itself being forked. What if Ethereum were to go to proof of stake? What is that fork going to do to all of the projects that are stacked on top of it? I think at last estimate, all but like 39 of them are basically gonna hit the wall and splat when it forks. And I don't recall where they got that estimate, but like it was something based on the intrinsic traits of the contracts themselves, that because they were set up a specific way that like they estimated 39 projects would maybe make the grade, maybe. And that such a transition to POS would, like I said, it would just run the rest of them right into a big ass liquidity wall. Or it would put their networks to a halt. And that is, of course, if they're directly associated with Ethereum on that level. And, you know, I think we can fit in one more paragraph on this one. I ranked Tornado third above the lending and trading protocols because wealthy users who will provide the vast majority of capital in these protocols require the presence of other wealthy users, and because wealth is not distributed evenly, relatively few wealthy users, I expect that the market may only support 1 to 2 privacy marketplaces rather than the 10 plus that are available in trading and lending. While I noted above that synthetics and compound are similar, I ranked synthetics above compound because of the real asset to synth bridge. One of the common traits of the protocols in the bottom half of the list is heightened competition. This is clear empirically. Entrepreneurs and venture investors are betting that these markets are not that defensible. Furthermore, as discussed above, competitors can bootstrap liquidity in most of these markets fairly easily by subsidizing liquidity. Yeah, and you know we're going to hang it up right there. But yeah, you can hear in the reasoning that this guy lays out to begin with that he's not entirely based on planet Earth. And that in no time in this whole discussion of forking DeFi protocols is he really referring back to what provides all of this. And that's people like you. See, people like you mine the transactions into the blocks, and that's the basis where they lock up all these funds. Well, you know as well as I know that you're doing it out of self-interest. And if it becomes more valuable to you to try to abuse their transaction in some way, shape, or form that advantages you above others, then you're gonna fucking do it. I mean, really, it's not a crime. It's not, it's some criminal activity. It's the incentive is provided, and so you fucking do it. That's all there is to it. These are incentive-based networks, and if the incentive is provided and it's leveraged too far to one side, people are going to fucking abuse it. They're going to exploit it because they want that fucking incentive. That's what mining is for. That's why we have global decentralized networks of miners supporting things like Bitcoin and Ethereum. But these guys are trying to get around that. And it's because they can't break that trust layer. It's not really a trust layer. It's you're either going to do the fucking work the right way, or chances are we're going to outpace you, we're going to beat you to the block reward, and you're not going to get it. Or you might not get it more than just a cut of it. And a lot of people can't handle that kind of competition. They look at that kind of competition and they get all pissed off about it and whatever. And the fact of the matter is that if your interest and your business acumen is such that you can be trusted with other people's money, make a goddamn cryptocurrency of your own and launch it. Quit looking at Ethereum with some sense of envy. Because I'll tell you what, Vitalik did not get to where he is by looking at Satoshi Nakamoto and being angry at him or jealous at him. He said, you know what, I think I can do better. If you think you can do better, then do it. Don't fuck around with trying to get people's money roped in. I mean, there's a number of legitimate ways to go out there, bust your ass, produce something, and still fail and not be considered a fucking criminal. And that's by actually trying to achieve something legitimate. And if you do fail, you fucking fail. Big whoop-de-doo. There's thousands of projects out there that have failed. But when you design your project from the get-go to fail, and it does fail, we're just going to point at you and say that person's either a fraudster or naive. Let's figure it out and get some restitution going. And because all of this shit is happening at one point or another on chain, we will figure it out. And if it wasn't happening on chain, then nothing happened, in which case we could probably classify all of the activity under fraud. Just blatant, outright fraud. Take that one to the bank. Anyway, let's go ahead and wrap this one up. Thank you very much for listening. I certainly do appreciate the support. My apologies for starting so late, but, it took a little bit of more time getting off of the water than I really wanted to, but hey, these things happen, And as far as our last dance is concerned, you know me, I haven't picked it out, but I did want to say, let's see here, let's figure it out first. That one, no, it's too long. Shish kebab. I know, we got to go to 9 Inch Nails for this one. You know I'm going to do it. Here it is. 9 Inch Nails. 9 Inch Nails. 9 Inch Nails. Last Dance. Big man with a big gun. Thank you again for listening. I want y'all to trade safe. Oh, we'll be back again on Wednesday at 8 p.m. Pacific Standard Time. So until then, I want y'all to trade safe. Do your homework. Because that's what we did today. And watch out for your own bunghole, because these motherfuckers most certainly are not going to do it for you. And so our last dance, 9 Inch Nails, big man with a big gun. Thank you again for listening, and you all have an excellent evening. Good night.